Alright, hello guys. Welcome to the stream. Sorry about the delay because for some reason Windows decided to make my Windows cursor just disappear. So really interesting. Don't know why that happened. Anyways, you guys can hear me loud and clear. Can I just check? Just let me know in the chat. Is the volume just nice for you guys? Alright, let's get rolling, guys. Sorry for the delay once again. Alright, so firstly, how many of you guys actually participated in the call I had last week? You know, the one I had about the um, IBDA data range. You know, I actually gave you guys certain news analysis that I expected the DXY prices to go up, right? All right, it's okay. I'm gonna do a little recap later on. What I'm gonna do now is we're going to cover the weekly outlook for the month of February, the first week of February. So last week we had the non-farm payrolls. Essentially, what the non-farm payrolls actually indicate is the amount of jobs created in the non-agricultural sector in the US market. So how these non-farm payrolls actually guides the decision of the Feds to decide whether to hike interest rates or maintain or even cut interest rates is that if in the economy, if there are more jobs, that means there's higher spending power for the masses, higher spending power for the consumers. So what this usually says that this cycle actually brings about inflation. I won't go too deep as to why that leads to high inflation. If you guys are interested to know more, you can watch the previous live call to get the understanding. I'm just putting it out here to do a quick recap. Right? So higher spending goes to higher inflations, and higher inflation ultimately leads to um, no change in interest rates or interest rate hikes. Now, I don't really think that the Feds have any reason to hike interest rates further because that will bring about the demise of the US market. So it's definitely unsensible to raise interest rates at this point of time. So the other option the Feds have is that there'll be no further change in the interest rates. So this no change in interest rates ultimately led to a higher dollar. As we see here, we actually saw a breakout from the consolidation range on the dollar index. So we've been trading inside this entire range. This is at the start of January. We entered the first consolidation stage. Sorry about that. I'm a little bit under the weather. So we entered a consolidation stage in the first week of January. We saw a sudden buy. A lot of people actually pumped the market in the dollar index, and then we entered a second stage of consolidation in the dollar market. So now ICT actually mentioned that he does not trade the entire of January and he will only be coming back in February. So now it's the month of February. In 2 days' time, we will see ICT enter the Robins World Cup. Definitely something very interesting to see and a very interesting time to choose to start his trading journey. All right. So on the 6th of February, it is the second day of our trading week. All right, tomorrow's the 5th, and then Tuesday's the 2nd. So based on ICT's trading rules, he doesn't actually trade on Monday. You know, because Monday he's letting price sort of build the narrative, tell him the story, gives him indications of what price might do in the coming week. So ideally, you start trading on Tuesday. Monday sort of gives us a confirmation of what price is going to do. All right, so that is the trade plan for the week. I will begin trading on Tuesday. I know some traders will be taking trades on Monday, and that's completely fine. I think the move is actually really obvious. So if you guys are in our premium signals channel, you would realize that actually Mimi Boo Boo did place a signal for a certain pair. And I can't really dive too much into detail as to why that pair and why that certain move, but you will be able to see a hint of it somewhere when I do my analysis. All right, without further ado, let's get into the charts. So as you guys can see here that we are actually in a market maker buy model. So I did send this out in my Discord analysis, and I did give you guys examples. Ideally I expect price to pump up and smash through these highs over here into this monthly fair value gap. Now this is a daily fair value gap within a monthly fair value gap. So what that indicates is that it gives me further confluence that price actually wants to refill this area of imbalance here. Coupled with this imbalance area, we actually see an order block here on the daily time frame. So usually these institutional levels of support, the institutional levels of resistance are considered really high probability. We might see some reaction off of it, maybe 30 pips, which is enough to catch a trade. But even though it may not align with our narrative, which is a higher dollar ultimately. So definitely I will want to continue buying the dollar all the way until we smash through these highs. So this highs is around 104.270 and fill this fair value gap that starts around 104.559. All right. So this is a very, very basic look at the dollar index. It's just higher prices. It's very simple. When the market opens, let's go on the lower time frame. When the market opens, I actually expect to see a lot of bullishness because Asia session is kind of lagging behind by a bit. And who trades Asian sessions? I mean, it says in the name, right? The entire of the Asia continent, mainly the Tokyo Exchange. So the Tokyo Exchange mainly deals in the bond market as well as the exchange of currencies. Very different from how the stock market exchange works in New York. Right? So we might see a continuous pump going into Monday. Uh, Eventually, I do expect this imbalance to be filled, but we are still incredibly bullish on the dollar for now, so I do expect it to fly up higher to take out the highs as mentioned, maybe. Or, there's a chance that you see these three black candles here. This may become an order block for further potential entries. So if Monday were to play out like I said, that means it actually breaks the high over here. It forms a new high. We might see a retracement down into the order block. And then we see price pump up into our initial targets. So ultimately, this is the play that I want to see. There is a lot of different types of things that may happen. We might even see price start to immediately fill this fair value gap here and pump up. But ultimately, both analysis actually points you in the same direction, which is a higher dollar. Alright, so even on the fundamental side, I've actually explained it to you. We are still expecting a higher dollar because Jerome Powell mentioned on Wednesday last week that they're not very confident on a rate cut in March. Now, take note of the date I'm telling you, March. That is when they will release the interest rate decision for March. For the first interest rate decision, yeah, it will be in March. I can't remember the date exactly, but just remember the month of March. This one will be important for our data analysis later on. All right, okay, now we're down in the dollar. We've sort of built the entire story of the dollar here. We actually took up all the liquidity over here, so that's really good. And there's one last liquidity, which is this point here, which I expect to be ran out anyway. All right, moving on. Since we have the narrative and then bias on the dollar, let's check out the Euro USD. Okay, so you guys may be wondering what are these points that I marked here. These are actually potential entries that I tried to take, but eventually got stopped out at break even because of how wonky the January price action is. Okay, so we actually see price retest these PD arrays multiple times, which is definitely very, very interesting. Okay, because we're not really seeing much respect on the bullish PD arrays, but we are seeing significant amounts of respect on the bearish PD arrays. So for example, this breaker, which I've actually marked out since a long time ago. You guys would have been able to see if you were in the Discord. You see the price actually hit it. Okay, it actually went back, retraced, hit the breaker block here, tanked, and then it formed a fair value gap within a order block here. So OBFVG went back up, hit it, tanked. All right, slowly. I tried to short from this fair value gap here. Price actually did tank for a while, and then it reversed. That's why I got stopped out at break even. But look at where it reversed to. It went from here, pumped all the way up, retested this OBFVG, formed relative equal highs. This is a form of engineered liquidity actually. So because anyone or any ICT trader or pattern retail trader, they're gonna see this as, oh wow, this OBFVG is so strong. You know, every time price retest it, it dumps all the way. And this is a very significant dump. Let me show you. We're talking about an entire daily range here. This is about 85 pips. It is basically the entire daily range, and people can hit like 8% trades on this. This is crazy. Alright? So we form some liquidity pool here because now everyone's gonna try to go short. Right? Everyone's gonna try to go short and place a stop loss here because honestly, if I saw this and I had no context of what the market is doing, which is most traders during January, it will make perfect sense to maybe, let's say you entered over here, all right? You entered over here, you place your stop loss above this high, and you try to target some even lower time frame, higher time frame target, which is the one I marked out here. Price would actually just go to like halfway point, and it reverses to take you out, especially if you didn't set it at break even. Do note that setting your orders at break even is also considered generating liquidity because ultimately liquidity is an order. It does not matter whether it's a buy sell order, is as long as there's an order at that price level, it becomes a liquidity pool if enough traders place their stop loss at those areas. All right, so it will make sense that this seems like something suspicious, right? Because usually for ICT, we do not see PD arrays being respected twice in a row. Usually when it's the first time it's respected, when price moves back up there, is usually a suspect move. A suspect move being it's fake. All right, because usually you don't see a retest of mitigated PD arrays. So what should have happened if that PD array was real was that price actually went back up, tanked, and never went retraced all the way back up there again. All right, there's going to be another PD array created in this entire leg down, and price will respect it. So this is what happened last week. A lot of people were baited into shorting the market early, and they eventually got ran out. And what happens when they got ran out? Again, retested this breaker, and we saw a huge tank from NFP, wiping out many traders here. This is why I say that even though you guys know the direction of the trade, it is not worth to trade this big impact news because price can still be relatively unpredictable. They stop you out and then they show you the true move, which is what we analyzed. So all this is not worth getting into, all right? So after the NFP day, this candle is the NFP candle. Oh, sorry. Just want to check in with you guys. Are you guys clear on what I've just mentioned? Are you guys clear? Let me know in the chat. And if you have any questions, please feel free to ask me as well. Don't want to get carried away explaining. You guys clear? All right. Now, so a quick breakdown on what's going to happen uh, in the immediate time frame. So on Monday, again, remember our DXY, I said I expect a lot of bullishness. Asian session is trying to catch up to the market, so they'll just buy up the dollar. So the same thing can be expected because the dollar index is inversely related to the Euro USD. We can expect a sell off on the Euro. And what do we see on the Euro? We actually do see this double bottom here. And usually double bottoms are very great indications of a liquidity pool. Because if you see these few green candles here, these are the early buyers. People who are trying to long the market. Okay, this is how they're thinking, all right? They hope to get, or they see this as a strong support level, all right? They want to long it up to this point. This is an inefficiency, a very big one. However, although I do see this inefficiency being filled in the later time, I do not expect price to actually reverse yet so quickly. All right, this is a very, very big liquidity pool. And as you know, the algorithm books price such that price moves into areas with like the least resistance. So this move here takes about 20 pips, whereas this move here, the close is around here, takes about 7 pips. You don't even need to know ICT concepts for this. You guys study physics, you will know that electricity and current moves into areas of the least resistance or something like that. I've kind of lost touch with my science part, but it's kind of the same concept. Would you think price will move 20 pips in a low liquidity session, which is like the Asian session, where there's not as much money flowing into the market as compared to New York and London? Do you think they have the ability to move about 20 pips up? Or is it easier to just go with the current trend, pair orders, and move it down by 6 pips? Of course, the 6 pips one actually looks more uh, possible, right? We might see, oh yeah, we might see some slight retracement up, clear out this high, and then dump. But I really don't think that price will retrace all the way back here. But then the thing is, anything can happen still. Ultimately, I am just trying to predict the market, and these are all probabilities. I do not run the market. The market can do whatever the heck it wants to. I'm just telling you the most probable move right now. I want to see these lows being ran out on Monday, and then retracement maybe can form around Wednesday or Thursday with the news drivers. Yes, we have news coming in on I think Wednesday and Thursday, which is enough to possibly get us a refill of these inefficiencies here before going down and tanking to the liquidity targets. Now, this is the bulk of what I taught you guys last lesson. I'm going to bring out the indicator again. So again, remember the narrative: higher dollar, lower euro USD, extreme bearishness on the euro on Monday. Look to take trades on Tuesday onwards. Unless you are in our premium signals, then you will know what we're talking about on Monday. So for those of you who are interested to see what we have for you guys in the Trader OS, which is our premium services, you can actually click the link in the description below to get a 14 days free trial just to see what it's like being on the premium side of the Discord. Alright, if you don't like it, you can always cancel it. There's to be no fees charged to your card if you cancel before 14 days. Alright, moving on. Remember I showed you guys this interbank price delivery algorithm, right? So initially this area here, it was the low of the IBDA 20. And this A means anchored. Alright, why do I say anchored? Anchored as in, the anchor they have out on ships. So it's anchored because I actually anchored it to this turning point here. This area where there's a change in the delivery state. Alright, we went from a bull trend to a bear trend. So usually this is usually used as a reference point to determine the IBDA 20 and to IBDA 60 look back, which is looking back at the 60 days from this area from this point on, and the look forward, which is the 60 days looking forward. All right, it's in the name itself. So to sum it up, what I preached was that the IBDA 20, IBDA 40, and IBDA 60 lows will be ran out in the next 60 days. So currently we're in the 20 day to 40 day range. So we still have a lot of days to go to see these areas being ran out by the algorithm. Alright, so far so good. Everyone can catch up. Let me know in the comments, please. Let's try to make this interactive as possible. Nice, nice, good, good. Good to see you guys are catching up. So this is the IBDA 20 anchored. All right. So again, I want to see these lows being ran out up till the 60 days mark. Now, I'm going to show you the variable. The variable is the one that says V. All right. The variable for the interbank price delivery algorithm is aligning with the anchored, such that now if because ICT actually does preach using the variable IBDA lookback as well. So if we're using the variable IBDA lookback, the IBDA 20 does not make sense because we are at the new lows here. We are forming the current lows. So it does not make sense to look at IBDA 20 to find out what lows will be ran out, right? So if the IBDA 20 does not work for you, we have to look at the IBDA 40 and the IBDA 60. So now we look back at the IBDA 40 from the current day. We can actually see that we have this low here, which is actually a coincide. Oh sorry, let me clear my throat real quick. Sorry about that. We can see that it actually coincides with the IBDA 20 range for the anchored version. So I'm going to bring out two indicators now. You see how the IBDA 20 anchored, which is the one demarcating the change in delivery state, is now aligning with the IBDA 40 of the variable lookback. Alright, this is very strong confluence that, alright, something is up. Price is going to run the low for sure. Because now you have two things using the IBDA data range that's telling you that price is going to run this low. Alright, because we are in a sell program, we want to see certain significant lows being ran out. Sure, this may be a very, very significant support area. Alright, this might be a very big order block. Some people say, oh, it's going to reverse from here, but think about it. If we reverse on the Euro USD, then we need to see a reversal on the dollar as well. But why on earth would the dollar reverse for no reason, right? I mean, FOMC and NFP has already set out the outlook for 2024, and the outlook for 2024, at least for the first quarter, is that we're going to see higher dollar prices. All right, we already got some form of a hint from Jerome Powell that currently they are still not very confident that cutting interest rates would help to, soothe the economy. It doesn't work that way because now we're still seeing very strong NFP numbers. We're still seeing a very strong economy in the US. It doesn't make sense to cut interest rates at this point. All right, so if they don't cut interest rates, that means you are maintaining interest rates or increasing them. But I don't think it's increasing. It's more of maintaining interest rates. Then that equates to a higher dollar, right? So why would it reverse from this point? So I see this as a potential trap for a lot of traders, position traders as well. Most would probably just go long here because it hit some order block in a, I don't know, bull trend. But all this is in the past, and I expect price to actually run this low. So this actually induces a lot of orders. A lot of people are actually pricing orders here, and they'll actually find themselves getting stopped out. All right, so usually when there is a change in delivery state, we usually see some form of major liquidity being ran. So in this case, the major liquidity is this line here. All right, the price is around 1.07261. So this is the major liquidity point. When it runs this point, then we can start to reanalyze the markets, see which day we're at. Are we in the 40 to 60 day range, or are we still in this middle portion range here? We have to relook at the markets, and I will be there to guide you through this. But all you need to know now is that this is the current target for the Euro USD. We have two confluences right now. Right, both IBDA data ranges are giving us the same idea here. Now, remember when I told you just now that I said something about, oh, March is when they announce the interest rate things, right? And then that will shake the markets a lot because that is somewhat of the confirmation of the Fed's hawkishness on the market. Let me show you something. This is where things get a little interesting. So I've identified this here, and I've told you guys about it since the last stream. Now, what's the significance of the look forward, right? I told you guys that, oh, the look forward actually gives you a sort of a time frame for price to run the liquidities that you have identified. So usually we have the 20 range, you run some form of liquidity, 40 range, you run some form of liquidity, and finally the 60 range before you relook at the markets and reanalyze again. Now let's just check out where the 60 look forward lies, all right? 20 is in January, 40 is in February, and 60 is in March. The same month, FOMC is going to release the interest rate results, their final decision on the interest rates going into the second quarter of 2024. Is this a coincidence? Do you guys think it's a coincidence? You guys are clear on this? You guys get what I'm hinting at? Let me know in the chat. We have a timeline using the IBDA data range that aligns with current economic news factors. And they're all pointing to the same date in March. This is how algorithms look at price. All right, they don't just refer to price that's happening way before. They also sort of have an idea of what they want to do moving forward. So sorry, just want to check. Is everyone clear on this? Let me know in chat. Anyone? Alright, if there's no reply, I'm just gonna continue. Okay, I'm just gonna continue. We can expect a potential dump all the way to clear out this liquidity. It may not reach IBDA 60 anchored. It may just clear the first three here. But as we enter the third look forward, we have to be a little bit more careful because we are approaching the interest rate announcement. All right, this is our line here. Treat it as a warning. I'm going to mark it out here. I'm going to show you one more data that's going to be very, very interesting when you see it. And it'll make you question everything. Alright, this is not just a coincidence. I have 3 confluences pointing to the same exact date. And I'm going to show you one more. Alright, so let me just mark this out. 22nd March, Friday. Not sure what's going to happen there. All I know is that price is going to reverse going into the third month of the first quarter, which is March. Alright, so again, can expect price to go deeper all the way until we hit this area here, and then we have to observe the markets again. Alright, so the weekly outlook, the bias for dollar is a higher dollar, and the bias for foreign pairs is lower prices. Alright, now I'm gonna bring out this chart that I sent you guys on the Discord. I'm gonna try and see if I can bring it up on the screen here. Alright, are you guys able to see it? You should be able to see it. Yeah. Okay. Now, I've marked out the lines here by quarterly shifts. So how the market works is that every single quarter, we can expect some form of a shift in a bias of prices. So this is the 33-year seasonal tendency for the dollar index. So the red and blue just marks out like the past 15 years or the past 30 years. So 15 or 30 year look back. All right, this is all algorithmic data that's been collected to show you the seasonal tendencies of the dollar. All right, so this is the data from 2017 to 2018. But the year doesn't really matter when the data is gotten because again, it is a compilation of all the data dating back 33 years ago. So I want you to take a look at the first column here. I'm able to show you my cursor because uh, it's some OBS restrictions, so you just have to bear with me for a little bit. notice when the red line changes, right? You see the black line that's on March right now? The first black line you see on March. That is when we see some form of a seasonal tendency change of the dollar index. You see the dollar from January all the way to March, we see dollar prices going even higher. And the moment we hit March, it reverses. For the past 30 years and for the past 15 years, the dollar price reverses all the way up to May. Now, May is interesting, but I'm going to save that for a later lesson because honestly, I can't cover everything in this lecture alone. I mean, any guru out there can lie to you using patterns, but I cannot lie to you using facts and data. I'm showing you all the facts and data right here. Alright, I'm not making this up. You can go online and search this. You can use uh, data from the banks or something. All this data is public. The only thing that's not really public is what I just showed you just now, which is the how the interbank price delivery algorithm works. Alright, so we see this quarterly shift. Now think back, doesn't this align with what our analysis told us? We have higher dollar January to March. We see it right now. January price is increasing all the way. And then based on the IBDA data ranges, in the 60-day look forward, we see price is indicating some form of reversal, which is in line with what this 33-year-old data tells us, a reversal in March. Now, what may cause the reversal is something that's unknown to me. I do not have the power to know that. And if anyone says they know what's going to happen in March, they're lying to you. All right, we can't predict what kind of global event is going to happen in March. All I can say is that it's definitely a time to reanalyze the markets. Do you guys see what I'm pointing at here? Can you guys let me know in the chat if you guys are clear on what I'm trying to teach? Do you guys see the similarities in the data I'm presenting to you? All right, thanks for the reply, guys. I really appreciate it. I want this stream to be as interactive as possible. Ah, okay. It's okay. You can definitely rewatch this anytime you like. It's something that, you'll be using it in the later days as well. All right, so let's go back to the charts. So you've seen the dollar index, you've seen what the IBDA is telling you. I think there's really not much more for me to say. Everything else is up to your due diligence to do your research on the fundamentals, the current news, and everything. Now, I actually do consider using one more set of data, but I'll probably send it in the Discord. And this data is actually called the commitment of traders. So, what the commitment of traders does is that it tells you what the institutions are thinking. Now, a lot of retail traders are actually using the commitment of traders data wrong. There is a secret to uncovering what kind of program we are in. Are we in a buy program or are we in a sell program? Now, I'm not going to show it up here. I'm going to show it in the Discord, and maybe I'll have a lecture on it specifically because there's just so much about it that I can't finish it tonight, and it's getting late as well. All right. So I'm going to sum it up on what commitment of traders data can tell you. In an institution, right, there's a hedging program and there's a main buy or sell program. So there are two current programs running in institutions. So you know that banks trade very differently from us, right? So we can't refer to like RSI or MACD to trade because those are very lagging indicators. And the commitment of traders data is a leading indicator in telling you what price does. So I'm just going to leave it at that and I'll cover it next time. So we've come to the end of the weekly outlook and the data analysis. I hope you guys actually managed to learn certain things from this. Do you guys have any questions you would like to ask me? I'll answer you on the spot right here. Just let me know in the chat, and then we can call it a day if there are no questions. Alright. All good. Okay, in that case, because I can't do this live stream every single time I have an update, it's unsustainable. Most of the times, the updates are sent via Discord. So if you're a viewer and you have not joined our Discord, be sure to join. The link is in the description. If you guys want our signals, you can use the link in the description as well for a 14-day free trial. Now, this free trial, obviously, you might have to put in your card details because we're using a third-party application to process our payments. But if you are unsatisfied or you do not trust the analysis, you can feel free to cancel anytime as long as it doesn't hit the 14-day mark and price won't be charged to your card. All right? Yeah, so that's all I have for you today. Thanks for joining, guys, and that brings us to the end of our weekly Outlook video and live lesson. All right, so I'll see you guys next time, man. Bye bye.